Hey everyone, welcome back to Corporate Decoder. Today, Variant Alternative Income Fund just filed its annual report on Form N-CSR, and I am seeing some fascinating shifts in their strategy that could impact your income. Quick note, this is not financial advice, just my take on public filings for educational purposes. This fund is all about getting you consistent income by investing in some pretty unique places, but their latest report shows some big moves in how they are managing that. So what is this Variant Alternative Income Fund really doing? Think of it as a fund that tries to make money from places far away from the regular stock and bond markets. They mention things like legal lending, film finance, and even diamond lending. The idea is that these kinds of investments do not move up and down with the rest of the stock market, providing you with a steadier income stream. They are calling this strategy Income Done Differently. And who is running the show? It is Variant Investments LLC. And they are pretty serious about this different income approach. They are registered with the US Securities and Exchange Commission, or SEC. And they operate as what is called an interval fund. This means you can't just buy and sell shares on any day. There are specific times you can. And that limited ability to sell is a big part of how they manage their unique investments. Now let's dive into how the fund actually performed. For the year ending the 30th of April 2026, they reported a net total return of a positive 7.01%. Over 5 years, that number improves to 8.05%, and since they started, it has been about 8.51%. They are comparing themselves to other income-focused investments, and they believe they stack up well. Interestingly, they say that real estate was their biggest moneymaker this past year, followed by legal lending and corporate loans. On the flip side, inventory finance was the only area that lost them money. Where is all the money actually invested? Looking at their portfolio allocation, a huge chunk, 70.3%, is in credit facilities. These are basically loans they've made. Then about 20.8% is in private investment companies. This means they are investing in other funds that themselves invest in private companies. Special purpose vehicles make up another 6.9%. And they also dabble in money market instruments, warrants, and direct equities, though those are much smaller pieces of the pie. Let's look at the balance sheet as of the 30th of April 2026. The fund has total assets of over $2.6 billion. Most of that is in investments, but they also have a significant amount in cash and receivables, totaling over $75 million in interest receivable alone. On the liabilities side, they have about $183 million in revolving credit facilities, which means they are borrowing money to invest. Overall, their net assets close to $2.45 billion. Now for the income statement for the year ending the 30th of April 2026, they brought in over $289 million in total investment income. A big chunk of this is just plain old interest income, over $128 million. They also get income from dividends and, importantly, specific types of interest like PIKE interest and event-based interest. Expenses are significant too, with over $26 million going to investment management fees and over $13 million in interest expenses. After all is said and done, they had a net increase in net assets from operations of over $178 million. Looking at how their net assets changed over the past 2 years, for the year ending the 30th of April 2026, their net assets actually decreased by about $281 million, and the previous year they decreased by over $372 million. This is primarily due to the distributions they are making to shareholders, which were over $252 million in 2026 and over $275 million in 2025. They are paying out a lot of money, which is good for income, but it does reduce the fund's overall size. For cash flow, the fund generated over $398 million from operating activities, but when you look at financing activities, they used over $405 million. This difference comes from them selling shares, paying back loans, and distributing money to shareholders. Ultimately, their cash and restricted cash decreased by about $7 million over the year. Let's look at the per share performance for their institutional class shares. For the year ending the 30th of April 2026, the net asset value per S-share was $25.93. This is down from $26.74 the previous year. The total return for the year was 7.01%, which they are happy with. However, the ratio of expenses to average net assets is about 1.80%. This is a pretty standard expense ratio for this type of alternative fund. They are also using leverage with over $183 million in borrowings at the end of the period. Now, let's get into the notes to the financial statements, which give us the really important behind the scenes details. This fund is structured as a Delaware statutory trust, and it is an interval fund. That means they are required by law to offer to buy back some of its shares from investors every quarter. This gives investors a way to get their money out, but it is not like selling on a regular stock exchange. They've also set up 2 subsidiaries, Virginia. IFB, FBV, LLC, and VAIF, the second SPV, LLC, which are wholly owned by the fund. These subsidiaries hold a significant amount of the fund's assets, over $745 million, and are used to pledge assets for their credit facilities. They are using US generally accepted accounting principles, or US GAAP, and they make estimates that affect the reported numbers. Crucially, they explain how they value their investments. For things like private investment companies, they often use the net asset value provided by the manager of that investment as a shortcut, but they do adjust it if they feel it is necessary. For credit facilities, they use a discounted cash flow method or a market approach. This means they are really digging into the expected future earnings of these loans and the value of the underlying assets to figure out what they're worth. They also had futures contracts in their portfolio to manage foreign currency risk. This section really gets into the nitty-gritty of how they value investments that don't have a clear market price. They use a 3-level system, with level 1 being the easiest to value because it is based on active market prices. Level 3 is the hardest, using unobservable inputs. A big part of their portfolio, over $1.7 billion, falls into level 3. This includes their credit facilities and special purpose vehicles. They are using things like discount rates, recovery percentages, and market multiples to determine the value of these hard-to-price assets. For example, the discount rates they use can range widely from 9% to 40% for credit facilities. This part of the report shows where the fund has promised to put money to work in the future, but hasn't actually done so yet. They have unfunded commitments of over $13 million in transportation finance and significant commitments in specialty finance and royalties. 2. They also detail the redemption frequency and notice periods for many of their investments in private partnerships and special purpose vehicles. Some of these have lock-up periods, meaning you can't easily get your money out for a certain amount of time. Looking at what happened after the 30th of April 2026, the important stuff. They started another repurchase offer in May 2026, trying to buy back shares from investors. And here is a big one: they secured a new credit facility for up to $300 million. This shows they are continuing to use leverage and are actively seeking more capital to invest. Who is actually in charge? The fund is overseen by independent trustees like David G. Lee and Robert Seyfert, who have been there since the fund started. Then you have the interested trustees and officers like Robert W. Elsesser, who is the president and also a principal at Variant Investments, the fund manager. Kurt Fintel is the treasurer and also a principal. This shows a close tie between the fund's management and the investment advisor. Scroll item 13, portfolio managers of closed-end management investment companies. Item 13, and who is managing the money day to day? Robert W. Elsesser. Kurt Fintel and JB Hayes are listed as the key portfolio managers. They've all been with the fund since its inception. Interestingly, they also manage other accounts, and the table shows they have about $160 million in other registered investment companies, and about $13 million in other pooled investment vehicles. While they say there are no performance base fees on these other accounts, the sheer volume they manage means potential conflicts of interest are always a consideration. Scroll item 4, principal accountant fees and services. Item 4, what did the auditors cost? For the year ending the 30th of April 2026, the audit fees were about $282,000. Tax fees were around $14,700. The audit committee pre-approves all these services, and it looks like 100% of the tax and other services were approved by them. Scroll item 12, disclosure of proxy voting policies and procedures for closed-end management investment companies. Side M 12. How do they vote on company matters? For fixed income investments, they vote on a case basis, looking at loan documentation and borrower compliance. For equity securities, they generally follow management recommendations, unless it is not in the best interest of shareholders. They also state they may delegate proxy voting to a third party, but they keep the final responsibility. Scroll signatures, and who signed off on this report. Robert W. Elsesser, the president, and Kurt Fintel, the treasurer, have both signed off on this filing. So, what is the big picture here? This fund is actively using leverage, taking on new credit facilities to grow. They are making a big effort to diversify income streams beyond traditional markets, which can be a good thing for steady income. However, a lot of their investments are hard to value, falling into level 3, which means their worth is based on estimates and management judgment. The fact that they're using subsidiaries to hold assets and secure loans shows a complex structure designed for managing these types of alternative investments. The trend of decreasing net assets year over year, though, driven by shareholder distributions, is something to watch. It means they are distributing a lot of their earnings, which is great for income seekers now, but it also reduces the fund's overall capital base. My biggest concern is the heavy reliance on level 3 assets and the estimations involved in valuing them. While it is standard for alternative funds, it introduces significant uncertainty. What I am actually looking for is how this strategy holds up if market conditions shift dramatically, especially given their increasing use of leverage. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord community.